So the purpose of tonight's presentation is to talk to you about the opportunity that's available in One Call Capital, which is a fund that has recently launched. And the spirit and the thesis behind what we're doing here is that we're offering passive investors a consistent return in a market that is certainly feels uncertain. And so we've found an opportunity for alpha in the marketplace. And so we're going to walk everybody through our business processes and the kind of loans that we do. And this is an opportunity for you guys to basically buy into a financing company that funds real estate investors in their business. So, and Brad, if you don't mind monitoring the questions, because it's kind of hard for me to see from this full screen here. So what I'll do is make it like this. So the agenda tonight will be pretty quick. Go ahead and pull out your phones and grab this QR code so that you can grab a time on my calendar so that we can talk shop after we get done here. I'll provide this same QR code here at the end of the presentation, which I think will go for 20, 30 minutes, and then we'll have an opportunity for questions at the end. And we'll explain what a fund is and how our particular fund works. And we'll introduce you to some members of the team. Brad joined me tonight, and review the case studies of some of the loans that we've done. And then we'll see if you guys can stump the chump with some questions. See. Okay. So typical disclaimer, this is not an offer to sell. If you are interested, we'll talk, and then I'll actually provide you a private offering memorandum. But at this point, this is just a high-level presentation that's for informational purposes only. And this is a Reg D 506C fund that's intended for accredited investors. And we'll talk about what that is here in a minute. All right. So just in principle, what is a fund? You hear people talk about a fund quite a bit in the market, and I'm not sure everybody really entirely knows what that is. I certainly didn't until recently. And so a fund is a way to pool resources together in order to do an investment. And there are typically two types of members of a fund. One is called the general partners, typically called the fund manager or the operator, the sponsor. Should kind of synonymous terms, so you'll hear me kind of use those interchangeably. But the GP, general partners, are the ones that manage the fund. And then the capital investors are the limited partners, who are the passive investors in the fund. And so in this case, we're seeking an investment in our fund, One Call Capital, and some of you may be interested in deploying some of your available capital and getting a high rate of return while minimizing risk. And so our thesis is that's what we can offer to you. And here I'll talk about the mechanics of it. So capital investors contribute to the fund. They put in, say, $100,000 for their contribution into the fund. And then the GP, me and my team, we run the business of making investments. And we'll talk a minute about what the details of what those investments are. But once the investments return, in our case, interest, those returns are sent back to the limited partners. And then from there, the limited partners and the general partners split. And there's a kind of a waterfall that will show you on how the profits of the fund are split between the LPs and the GPs. Did we get a question on that one? Oh. Excellent. All right. And so this is the team. I'm the founder and CEO, and I'll have Brad introduce himself here in a minute. If you haven't met me before, I've been a real estate investor for several years. I used single family investing as a way to escape my day job in corporate America. I've raised lots of capital, I've done lots of deals. I host a podcast, have a YouTube channel, and all the socials along with it. And we even do a newsletter. So we put out a fair amount of content about real estate investing. And the latest adventure that I'm on is being a fund manager. And I recently brought on Kyle and Brad as part of the team. Kyle is a former military officer. He's a member of a director of a bank. Or he's on the board of directors of a bank, and he has lots of real estate experience himself. And he basically runs the back office for us. Then I'll jump over Brad for a second and jump to Valerie. She's our bookkeeper. She keeps us all squared away. And then Brad is our chief underwriter, and I'll give him the floor for a few minutes.
Hey, Brad DeGraw. And yeah, like Paul said, usually I wouldn't be on this side. I really just focus on the deals. So all day, every day, I spend my time just evaluating deals and just separating kind of tranches of risk. And that's my jam.
And he's very good at it. So a little bit of the mechanics of this. So borrowers come to One Call Capital looking for loans in our particular niche, which we'll dig into a little more here in a second. And Brad is the first point of contact from the borrowers, whereas I'm the first point of contact for the capital investors. And so on the back end, we have processes that do our underwriting and kind of review it, and then I serve as the kind of the last line of defense, and I basically say go or no go on if a loan gets funded or not. So we have multiple parties, and it's intentionally designed that it takes 2 out of 3 of us to make any decisions. So if any of us are on vacation or we get hurt or something, then the other 2 can still run the business. All right, so we'll talk about the background of the fund and kind of how we got to this idea of starting a fund in the first place. So I started investing in single family rentals as a way to get out of my day job. And in that process of learning how to be a real estate investor, I also learned how to issue loans out of my solo 401k, my self-directed IRA, and then of course some of my taxable accounts as well. And as I did that business, I found that my available capital got tapped out before long. And so I started raising private funds to do deals on my own, and raising private funds to do individual loans on projects that I came across. And then I decided to formalize a lending company, and I brought some team members on, and I took on some investors who actually invested in a small company. Several of us put in like $10, $20, $40,000, and we created a small seed capital type lending business. We had about 300K to work with, so we were very small, but we were able to turn our money quite a few times in a year's time. And I did that for 2 years, and that was my proof of concept that I wanted to be in the lending business, and I really liked that sort of business. And so that kind of led to me creating a formal fund called One Call Capital, and it's based primarily on lending to real estate investors on short-term asset-based loans. And so the fundamental that we're looking to solve with One Call Capital is, in the current market cycle, there's a lot of economic uncertainty if you're an investor. If you have capital to deploy, you're kind of wondering where you can get the highest yield, but also minimize the risk. The public markets are extremely volatile. Crypto is certainly volatile, and you're just not really sure where to put your money, because if you let it sit still, it's losing to inflation. And so we basically identify the problem that, what does a capital investor do in this uncertain market? And then on the flip side, from a borrower's point of view, a lot of operators, investors right now can come across some good real estate deals, but they can find them at quite good discounts, in fact, but they need access to cash, quick cash, to be able to secure those projects. And oftentimes traditional banks, especially in our asset class, aren't interested. The loans are too small, and they just don't typically are interested in raw land, which is what we tend to focus on. So our solution is that we basically connect capital that is looking for a high yield with low risk, and match that to deals that need cash to secure a really good discount. And so we provide asset-based loans to real estate investors, and we pool our funds together into a fund, and that gives us the ability to be very quick and nimble, and able to empower our borrowers to get a hold of deals very quickly. And so we fund no more than 50% loan to value, but in our particular asset classes, or our particular asset class, oftentimes the borrowers are buying the property for well below 50% of its value. And we'll talk about that in some of our use cases here in a minute. And then we charge quite high interest rates for the liquidity that we access to it. And then we share those profits with our investors. And then we use that physical real property as collateral against the loan. And so compare this option to what is available in the marketplace. So to be very conservative and safe, you could put your money into an annuity, a CD, or a bond. And we all know this is very low returns, and it's predictable, but it's probably losing to inflation. You're not going to be growing your capital very well by doing that. On the other hand, you can put your money into the public markets in Wall Street, like index funds or ETFs. And that market we know is also very volatile. And you certainly can win at that game, but it's a very long time horizon. And you have to make sure you don't get wrapped up into the irrational exuberance or the irrationality of the marketplace and sell at the wrong time. So spending time in the market over 20 years is probably a good strategy, but sometimes you're up and sometimes you're down. And if you need to sell while you're down, then you've lost all your gains for the last 15, 10, 15, 20 years. Or the other option is you could be an active real estate investor and actually do deals yourself, which is certainly a valid method. Many of us on here are active real estate investors, including me and Brad, but we have to spend a lot of our time actively running a business, managing tenants and toilets, or dealing with whatever headaches go along with the current kind of asset class that you're invested in: insurance, taxes, legal fees, et cetera. And so let's talk about this kind of at a one sheet of music, so to speak. So on the far right is the idea of doing funds or syndications. And then on the far left is this idea of using very conservative, safe investments, being annuities, CDs, and bonds. If you go across the range here, it's kind of ordered in the level of returns. So annuities, CD, and bonds are typically, single digit, low single digits, but 100% passive. The stock market or index funds can, depending on who you believe and who you read, you can get somewhere between 7 and 10, 12, 11%, depending on who, kind of what range of the market you're talking about, what timeline you're looking back historically. And this is, of course, based on the performance of the US economy. And this is also extremely volatile. But I think a lot of people agree that if you invest in the stock market over the long term and you don't sell on whims, you can come out ahead with somewhere between 7 to 11% return. And then an active real estate investor, there's a lot of data points on what people tend to earn, and it's on average 12%. And of course, this is, again, not passive. This is where you're having to bring your knowledge and wherewithal to bear and run a small business. Whereas the fund and syndication model is where you buy into a small business, like what we're doing at One Call Capital, and returns can be somewhere between 12 and 17% in the marketplace. And this is intended to be 100% passive. Okay. So our investment thesis, simply stated, is like in a market when you have rising interest rates, and we can use asset-based loans to offer a consistent, stable return, risk-adjusted return with high rates of return. And so basically we want to take the least amount of risk to get the highest possible reward, also it being secured by real property. That's our investment thesis at One Call Capital. And so let's talk about the types of loans that we do within our fund. We're very specific. We're a very specific niche. So we do short-term loans that are 6 months or less. And oftentimes the loan amounts are typically $100,000 or less. And so we offer short-term loans to land flippers who can buy a property at well below the market rate, charge them a fairly high interest rate for doing so, and then allow them to actually get a hold of that property, do their flip within 6 months or less. And then another discipline that we're getting into quite a bit more is what they call transactional lending. And if you haven't heard of this before, this is where somebody has access to a deal from a seller, we call them the A party, and you are the B, the investor is the B buyer, and they have a C in buyer in mind. And so they get the A to B contract tied up, they get the B to C contract set up, but they don't have the cash to actually close the transaction. And so transactional lenders can come in and basically fund the whole transaction. And it tends to be a very short 3-day, 72 hours or less situation. And of course, by offering the liquidity, we get a fee for it. Again, we're doing this at a very high scale or high volume of loans with very low loan amount. And then also each loan is secured by a piece of property that is either has a seller contract already at the title company, or is a 2 times collateral, meaning no more than 50% loan to value. And I'm saying a lot of things here. I'm looking for any kind of questions. Feel free to drop a question in the chat as we go here. Hopefully I'm just saying it so clearly that it's obvious, but if I'm not capturing everything, feel free to drop a question. Okay, and so here's our internal process. So a deal comes in, a borrower comes to Brad and says, hey, we have a particular deal. Brad does the underwriting, and then he sees if that meets our loan criteria. And we say no as often as we say yes. You just don't meet our bullseye. We're very specific. And then when someone does pass the underwriting process, we think of ourselves as a partner with them, and we establish kind of a repeat business scenario, and we use their real property that they have under contract as a collateral against the property. And so we do the typical land title search. We get a title commitment from a closing agent. We always run everything through a closing agent or a closing attorney, and then our terms are no more than 50% loan to value. And then once we confirm all those things are taken care of, all the check marks qualify, then we fund these qualified deals, and then the operators go and do their thing. They go and flip the land, they go and do the transaction, whatever their exit strategy is, they go and execute. And at the closing of the loan, we have a security instrument, mortgage or deed of trust, depending on what state we're in, and then a promissory note, which clarifies or details what the loan details are. And again, we're always using collateral, and the mortgage or deed of trust is the piece of paper that actually attaches that promissory note to the collateral or to the property as collateral. And then as they're doing their deal, our interest is accruing, and then interest payments are made and the payouts are made to investors on a quarterly basis. And we hold quarterly calls with every borrower. And if they're not performing, we tend to do very short-term loans. If they haven't moved their transaction within a quarter, we're having a conversation with them to see if they're on pace and if they're making sense, because we have an obligation to pay out our capital partners on a quarterly basis. And then once this is all said and done, the transaction is complete. We repeat the process 1 through 3, very much focusing on repeat borrowers. And we do seek out new borrowers, but we're just very selective. Once they have good credibility and capability, then they become our new partners. And of course, we have a chief operating officer in Kyle, who is always looking at the internal operations to see if we can make anything smoother or easier to manage. Okay, not seeing any questions. So here are the terms of the One Call Capital Fund, and this is the name of the company is One Call Capital. The limited partnership name is called One Call Capital Fund LP. So partners, limited partners, are investing into shares of the One Call Capital Fund, and then the partnership size is up to $10 million. Minimum commitment for accredited investors is $100K. There's a 1-year commitment period, which is fairly short for funds. Oftentimes it's much longer than this. So our idea is we're turning the money in 6 months or less, often 3 months, and we're paying you out on a quarterly basis. And at the end of 1 year, you can get your principal back, or you can decide to kind of recast the investment. And so the target annual return is 15%. And the offering period closes once we raise $10 million, then the fund closes. And the management fee that we're charging in the first year is 0%, excuse me. And the preferred return is 12%, meaning that One Call Capital and our partners the general partners do not get paid anything until the limited partners earn a 12% return first. So all profits go to the limited partners first until they get a 12% return. And then the general partners and the limited partners share the profits 50-50. So I can't restate this enough that we don't get paid until you earn your 12%, and we do not charge a management fee. Many funds do charge a management fee. Okay, yet we are in lots of states. Okay, so what are we doing to manage the risk? Anytime you're investing your capital, you want to make sure you figure out what your return is going to be, and how do you protect your principal. So the first rule of investing is don't lose your money, right? So risk reduction is we do short-term loans, 6 months or less. And then on average, I believe we actually do like our average turns out to be 3 months, but our terms are written to be 6 months or less. We do a very low loan to value ratio of only 50%. And that means that we can, it gives us room for error. We don't try and allow for error, but this gives us room for if there's a market correction or things aren't selling right, or we misvalue the comps, that we have a lot of room for error there. And then we do very small loans. So your investment is spread out over many small loans versus one big loan that if it were to go bad, then you're basically attached to the outcome of that one loan. And again, all of our loans are secured by a security instrument against real property. And then we love to work with repeat borrowers in this space of transactional lending and land flipping. It's a very small space. And it turns out that their reputation is extremely important to these land flippers. And so just working with experienced repeat borrowers is just a win-win scenario all the way around. So then I'll pass it over to Brad to talk about a case study.
Awesome. Do we want to go ahead and clear some of the questions out of the queue, or do we want to save them towards the end?
Yeah, let's go ahead and speak to them. So the one question that I see that Scott had is, are you currently loaning from this LP? And yes, the fund is where the capital goes, and it's where the loans come from. That's who issues the loan. Where are you incorporated? In the state of Delaware. The partnership size is $1 million right now, Todd. We land in several states. We do try and avoid states like New York or the New England states that just have very long foreclosure processes. Does that cover them all?
I think you nailed it. Yep. And yeah, we have risk mitigating strategies for different states that have different headaches that we may have to come into. So let's dive into some case studies. Like I said, this is more my side of things, where all day, every day, I look at deals, and it's really a matter of risk. Risk is our number one concern. That's our priority. The most we can do to mitigate the risk makes it more appealing to us. So here's a good example. This is an actual deal in Fulton County, which is Atlanta, Georgia. Small loan, $18,500. A lot of our loans, they're small, and that's why this niche is so profitable, because it's overlooked by other potential providers of capital. No banks, credit unions, they just really don't service this size of product. And so that's why this works. So this was a small $18,000, $500 loan. It turned around, and you can see on the screen, the payout was $21,500. A healthy return. And if you look at the little graphic there, that's what we call an infill lot. So if you go through a residential neighborhood, it's house, vacant lot, house. That is an infill lot. Everyone has, mail and recycling. It's a desirable place to live. There's just no house there. So it's great collateral for us. And if you have questions, throw them in the chat. We'll hit the next slide. Let me see if I have access. Boom. Here's a good one. Now, these are my favorites. We call these transactional funding. And Paul went over it briefly, but this is just kind of a little deeper dive. So when our clients have a deal tied up, they're in their option period where they have the right to purchase, but not the obligation to purchase. They can get the property under contract for a fixed amount. In this case, $58,000. I'm sorry. Yes, 58,000. Yep. And the loan was $50,000. So there's $8,000 worth of fees that the client took care of. That was their portion. And then there's the B2C. They went out and found a retail buyer, someone who's willing to pay a higher price for it, for $78,000. Now, different states have different criteria, and even different title companies within the states will prefer to do their transactions differently. But needless to say, they're able to do both transactions on the same day in a series, but they're not allowed to do what's called a pass-through, taking the B2C money, that's $78,000, to cover that first transaction of $58,000. And that's our little niche. That's where we fit in, and they pay a nice premium for it. And most of the risk is mitigated because there's almost nothing that can go wrong. And anything that could go wrong would be mitigated by not releasing the funds for the transaction. So signatures, money, closing the deal. So, and again, if you have questions, I can dork on this all night long. So just throw them in the chat and we'll dive into it. Let's go. And we have one more, and then I'll pass it right back over to Paul. So my thing is raw land. I like two-dimensional real estate. If you notice the trend here, there's no structure, there's no building, there's no home, just two-dimensional real estate. Here's just a snapshot of a payoff statement. They accrued $8,750 in interest, plus what we call an underwriting fee or an admin fee for $1,000. The loan amount was $75,000. When you add it all up, their payoff was $84,750. And not every deal closes on time. It's actually fairly common for some sort of delay, which is not a bad thing. It just means maybe all the signatures didn't show up or all the money didn't show up. Something happened to delay it. And you can see the per diem rate is even listed there. So long story short, the collateral was 5 acres. The loan was $75,000. It was a pretty quick 2-month turnaround, and it just works. And we do these all day, every day. So.
Yep. Okay. So here's our track record, and we're doing this. So since inception, we've done 58 loans. We have done $1.3 million in loans. Since that inception date, our average loan size is just over 25 grand. So, I've said before, our loan criteria is basically 100,000 or less. And you see our average is well below that. Done this, I think, now in 16 states, and our default rate so far is 0%, meaning we have had nobody default. Outside of the fund, I've had one default happen before because a borrower passed away. And so I have had to go through the foreclosure process and the mechanics and the fees associated with that. So I'm familiar with the process. And so we're always doing everything we can to avoid that. But it's pretty common in our business that a 1% default rate is what you're going to expect, because of just life happens. And occasionally there's going to be somebody who just simply physically cannot execute on the loan because of health reasons, or sometimes legal reasons, and sometimes just something tragic like passing away. And so our typical loan duration so far has been 3 months. And so this is the important part for all of you to notice is our average return inside the fund is 18%. And so remember, the preferred return is 12%. So all the profit of that 18 goes to the limited partners first, the 12%, and then the general partners and the limited partners split the difference 50-50. So the LP's returns are, in this case, are 15%, and the general partners earn 3% for managing the fund. Yes, all of the LP and GP returns are annualized, Todd. And those are paid on a quarterly basis. Okay, so here's some testimonials. Actually, I believe, Todd, Casey. Casey's a friend of mine who is a firefighter here in Little Rock where I live. And he also runs an Amazon fulfillment business on the side, and he does quite well with that. So he has some extra capital. And so he invested with us, and this is his take on working with us, because he's too busy to be a full-time firefighter, have a FBA business, and be an active real estate investor. So he takes his available cash and invests in the fund to get his 12 to 15% return without having to actively manage that process himself. So Scott points out that the Arkansas property was A, B to C because it was a transactional loan. So it's a very interesting scenario, Scott, and it's a very astute observation. On a B to C transactional funding, we will not send the fund to fund the A to B transaction until the C funds show up. So it's the lowest risk scenario you can possibly think of. So the funds are in the title company from the C buyer of $78,000, and then our money of this case $50,000 shows up to fund the A to B, and we simply will not fund and will not allow them to release funds until the funds from the C shows up. So in that case, risk is mitigated. Our loan to value ratio of 50% is for anything that doesn't have a contractual exit scenario for a land flip. Yeah, if C doesn't go to the deal, then A to B doesn't get their money because we don't process the deal until C funds the money. So it's as secure and safe of a transaction as I've ever seen in real estate. Yeah, so they're like 72 hours or less for the transaction alone. Okay, I think this is our last couple of slides, and this is another friend of mine, Ryan, who is also a note investor and buyer himself. And so he runs an active business where he's buying and selling notes. And so he has money in his IRA that he cannot get involved. He can self-direct, but he can't self-deal. So he wants an arm's length transaction in his IRA. So he's invested with us as well and getting the returns that we've forecasted here so far, and that way he can spend his time working his business of being a note buyer while also having his money in his IRA working hard for him without him having to be involved in all the time. So this is a very good opportunity for people to invest as a in their IRA or solo 401k because it's kind of an optimal environment because you want that to be, in fact, that has to be a passive investment for you. So that is a good place to store your cash, buy shares in our fund, and then let the transactions happen without you being involved. So you get the kind of returns that you would earn from an active business without having to be an active business. Okay, so what questions do you have? There have been some good ones so far. Go ahead and pull out your phones and grab this link. So if you're interested or want to talk shop, you can grab my time on my calendar. This is a link directly to my calendar. Todd said that's a good answer. Yeah, that's why we love. High five. Hey Todd, can we screenshot that?
Did you see Dan's question? That'd probably be a good slide to show kind of how we show transparency and accountability for the investors.
Gotcha. What was Dan's question?
Dan had.
Oh yeah, okay. What online access? So yes, we do have a portal, Dan. So investors in the fund have access to a portal, and they can see they get quarterly reports, and then at the end of the year you get the K1s. Okay. So Tigran asks, is the credit available for credit investors only? Yes. In order to have proof, there is just a simple form that your CPA or somebody official has to sign. I don't believe you can self-certify to be a credit investor, Tigran. But I have a form that I can send to you. So probably the best thing to do is just grab some time on my calendar and we can talk shop. I can show you exactly the form and what it takes. Have you done quarterly payouts yet? Yes, we did in fact, I think as of yesterday was our first quarter. So we've done quarterly payouts because I'm an investor in this as well. And so I received my quarterly payments. Well, and then of course, I've been doing this longer outside of a fund environment via a LLC scenario where the investors were members of the LLC. And so we made quarterly payments, or actually we did annual payments there. Good question. What other questions do you have? The loan
question about personal guarantees. Can I take that one?
Yeah, go ahead.
Yes, so the clients do sign a personal guarantee in most cases. There may be a rare exception where maybe they're working deals through a tax advantaged account. So that's not appropriate, but in 99% of the time, that's going to be true. They do sign a personal guarantee.
Yeah, if they're using their IRA or something, they're not allowed to personally guarantee it. They have to be non-recourse loans if they're in an IRA.
Can I take
Dan?
Dan's question about
Yeah.
loan to value?
Go ahead.
Okay, perfect. So this is kind of my side of things. So all day, every day, we look at deals and data. Land is kind of interesting because a lot of the land transactions don't go through MLS. A lot of them are direct transactions. So there's a couple of different sources, and every state's a little bit different. Some states, like my home state, Texas, they're a non-disclosure state. So that transactional data is not generally available to the public. And that's where it makes sense to team up like with a realtor who can pull the transactional data. Also, we look at the websites that do specialize in lands transactions. So you can get some data off like realtor.com. You can get data off like Zillow, but more likely Lands of America and specialty land websites like that will show you what's sold and currently for sale. And we comp it out just like any other real estate. And we need to be conservative because if you're not able to see the boots on the ground, you really need to mitigate risk. So we take the most conservative data we can find.
Good answer. So Todd asked, I thought funds could be held for 2 years. Is it really 1 year? And as you mentioned here, for One Call Capital, it is only required to commit for 1 year. That's on a per fund basis, Todd. So I'm not aware of any regulation that requires a fund to be held for 2 years. Some funds do it that way. I would say it's more common than not for funds to require a longer commitment period. But since we do such short-term loans, we can afford to do a short-term commitment because we're moving the money fast. I think the reason other funds would have a longer commitment period is if they were actually buying real property and they were holding and doing a value add on a multifamily or something. It's if suddenly investors wanted their money back in 1 year, they'd be in a world of hurt real fast. So that's the reason I think other funds require it for longer. Yes, 100K is the minimum investment. Yep. What states do you want to answer that, Brad?
Yeah, that's all me. So the most common state for us is probably Florida. The reason for that is Florida is very generous with the data. So if our clients can get good data and it's easy for us to have good data, it just facilitates more transactions there. Also, developers have sliced up Florida pretty well over the last, let's say, 50, 60 years. Texas, where I live, is big. Georgia, North Carolina, several states. But if we had to pick one state, it'd probably be Florida.
Yeah. So Florida, Texas, Georgia, North Carolina, so I think would be the order of priority, right? Yeah. Yeah. So one question I saw here is what state is there a minimum or is there a management fee after the first year? We don't have any plans to do a management fee after a year. So basically the way that works is after we've been open for a year, we can reassess to see if it makes sense for us to charge a management fee or not. And at which point, then if we decide to change and start charging a management fee, then investors at a year could decide if they wanted to continue or not. So it's meant to line up with investors. Good question. All right, so what time are we looking at here?
I think we're great on time. Are there some questions that we should have came across but maybe they didn't populate in the chat? We covered minimums, we covered time, we covered how the engine works, where the money comes from. Yeah. We covered a lot.
Yeah, one frequent question is, do the general partners have skin in the game? And yes, we do. We are LPs in the fund as well. About as it stands now, of the 1.2, about 20% of that money was from the general partners.
I think you nailed it. Just to take a quick poll of the audience, did anyone have any thoughts when we went through the, the comparison to other types of investments? Like, are you guys into like fixed rates of returns like CDs and annuities? Are you guys into real estate or the stock market that has some volatility? What's your portfolio look like? Have you done something like this before? Does this seem like it's a match? I'm just curious everyone's kind of journey on that. And
What's
then
your
maybe
take on it? Yeah.
throw that in the chat.
Yeah, drop in the chat. Yeah, I would say this fund is a good argument for a diversification play. So if you have your active real estate investments, you have something in the stock portfolio, you have your IRA, your 401k, and if you have some cash that's sitting, you're kind of wondering what you can get a good return on, but you don't want to do the work yourself. That's our pitch. That's our play. Yeah, so Scott does hard money loans in Memphis.
Good deal. So he knows the game. Like it's just so nice when things come together and you have great collateral and highly desirable assets backing up these loans.
It's within 2 weeks. So the question from Scott, so it's within 2 weeks of the end of the quarter is when the distributions are made. And Todd commented that I thought you were looking into some commercial investing also. Is it so we have, I would say, 3 potential loan products. One is for land flipping, which is what Brad's specialty is. Transactional lending, which is what we're really excited about. And then there is an option inside the fund to do, they call like bridge lending for construction loans. But those tend to be quite large. Since your fund is 1/10 the size and your loans are, well, I'll finish the answering Todd's question. I thought he was clarifying. So we haven't done any of the bridge loans yet, Todd, on the construction loans. Frankly, we're not capitalized well enough to do very many of those. So once we have a larger pool of capital, that might be a way to get funds deployed. So in the fund management business, you're always managing deal flow and capital flow. And so right now we're in capital raise mode and we have way more deals than we have capital. And so we have a lot of demand for land loans. And so we're raising capital. And once we meet that demand, then we could basically bolt on that bridge financing option, but we haven't gotten there yet. Since your fund is 1/10 the size and your loans are pretty small, how do you look to really expand your investments? Well, I guess that was kind of answering a question, Scott, is that there is a certain point to where we will hit a limit of available concurrent loans we can do with land loans alone. And so transactional funds can actually be turn while also a fair amount of your capital. But then also these bridge loans from construction loans, which is, I'm in the land up construction business myself. And so we come across a lot of opportunities there, but they tend to be multi-million-dollar or hundreds of thousands of dollars at least, if not multi-million-dollar projects. How soon after receiving my funds would I receive my first quarter distribution? So it would be on the first quarter after you put your money in, Dan. So let's say if you put it in now, then you would, once there's the next full quarter, you would get paid for the 5 months that had accumulated. So you still get paid out for 5 months of earned or accrued interest. It's just after the first full quarter. So we don't run a quarter per capital investor. We run on an annual fiscal quarter basis. Another common question that I get is, can you reinvest your distributions? And yes, you can. That's an option in the fund, like a little check mark, a little option. Do you wish to receive distributions, or do you want that redistributed back into the fund? And that basically ups your basis in the loan or in the fund. Good questions. Maybe I'll give you a couple more minutes to think of something else. And then if not, you guys can grab the link to my Calendly. I'll go ahead and how many years have I dealt with outside investors? 6 years. In various forms.
Scott had a good question here.
Okay.
Tax form at the end of the year.
Yep. Thankfully, I've hired a external third-party fund management company that they take care of all of that. So everything is in the fund. I've paid for their tax treatment services, and you'll get the K1 form because you're a partner in a company, and so you'll get a K1 per year, just like a syndication if you've ever done one of those.
Donna has a good one. To be honest, I thought the fund would be more capitalized by now. I have a response, but I think it's a Paul question.
No, go ahead, Brad. I'm curious what you have to say.
Well, we've been doing this model for 3 going on 4 years now, with specifically focusing on funding land transactions. Most of that was a proof of concept. The fund's only been live for how many?
5 months.
Yeah. So that's the reason this is actually the first launch of it. So that's the answer.
Yep. It's a lot of people are on the sidelines right now with their capital. It's just an uncertain market. And if you just don't really know what to do, and people are I think trying to like time the market, trying to figure out if there's going to be a recession or not. So I mean, fund managers across the board are talking about how difficult it is to raise capital right now. Yeah, see, God, it's pretty consistent. And you do what's right for you. I mean, this is a scenario where like it makes sense or it doesn't, and if it doesn't make sense now, it might make sense later. Yeah, so Scott, you would get a K1 at the end. Exactly. All right. I think that will wrap us up. We've been going for about an hour now, so I appreciate everybody's attention and great questions. And please grab the link, grab the time on my calendar, and we can talk shop and get you going. Nice meeting all y'all. Bye-bye.